taxes, and rental property. Part 2. How rental income is taxed in Singapore.
Well, Ali. I hope our future tenants like what they saw. But how do I report my rental income to IRAS? Can you tell me more?
That's right, Sam. You will need to report your gross rental income for the year. Say, your total rental income, including the income on rental of furniture and maintenance fee, is $2,500 a month from Jan. This works out to $30,000 in gross rental income for the 12 months in a year. Of course, if you only rented out your property for 10 months in a year, then adjust the rental period accordingly, and report the rental income for that period.
Thanks, Ali. Will the full $30,000 be taxed?
Certain rental expenses can be deducted from the $30,000, and only the net rent is taxable. There are two ways of claiming expenses. The easier way is called the 15% deemed expenses method. You can opt to claim an amount of deemed expenses, based on 15% of gross rent received, in lieu of actual expenses you incurred. Actual mortgage interest on the purchase of the property can be claimed in addition to the 15% deemed expenses. If you choose this method, you do not need to keep a record of your expenses. You will only need to keep the documents to support your mortgage interest claim. The other method is the actual total expenses method. You can claim expenses based on the actual amount of allowable rental expenses you have incurred, and deduct them from your rental income. You will also need to retain all supporting documents such as tenancy agreements, bank mortgage statements, invoices and receipts for 5 years for verification purposes. But, do note that not all rental expenses are allowable. Expenses incurred before your tenancy starts are not allowable. For example, property tax, fire insurance, mortgage loan interest and renovation costs incurred prior to the start of the tenancy period are not claimable. From year of assessment 2022, agent's commission, legal fees, stamp duty, and advertising expenses can be claimed on lease for first and subsequent tenants. Upon renting out your property for the first time, expenses that you incur in earning the rental income are deductible, except for capital costs, such as renovation costs and new furnishings. Some examples of these allowable expenses are property tax, fire insurance, mortgage loan interest, maintenance of property relating to the tenancy period. You may refer to the full list of deductibles on the IRAS website. If you terminate your rental, expenses incurred outside the tenancy period are not allowable.
I see. Oh yes. I will still need to pay $3,000 monthly installment for my housing loan. Is that an allowable expense too?
There are two components in the installment payment: the principal repayment and the interest on loan. The repayment of the principal loan is not an allowable rental expense. However, interests paid on the housing loan is an allowable expense. Since this would be your first time filing your rental income, let me show you how to do it, using a sample tax form. First, log in to My Tax Portal and go to Individuals, File Income Tax Return tab. Select the year of assessment. Add Rent from Property Information. In the address bar, key in the postal code of your property and click Retrieve Address. The house or block number and street name of your property will be automatically shown. You will only need to enter the unit number of the property in the Unit Number field. Next, enter the gross rental income for the year under the Gross Rent field. The 15% deemed rental expenses option would have been pre-filled in your online tax form. Don't forget to also claim mortgage interest on the loan taken to purchase the tenanted property under this option. However, if the amount of your actual allowable expenses is higher compared to the amount calculated under the 15% deemed expenses method, you could claim for actual rental expenses, since this will help you to reduce your net rental earnings and your income taxes. To claim for expenses, simply uncheck the 15% deemed rental expenses box, and enter the relevant expenses in the respective fields. Example: property tax, mortgage loan interest, commission, and repairs. You will also need to enter your share of net rent, based on the legal ownership of the property.
Thank you for the demo, Ali. By the way, the property is actually co-owned 50-50 by me and my wife. Do I report 100% of the rental income, since my wife did not receive any of the rental income?
No, Sam. Rental income is taxed on joint owners, based on their legal share in the property. It does not matter which party received the rent, or which owner paid for the property. So assuming the net rent is $12,000, you and your wife will each be taxed $6,000 as net rental income. It would be incorrect to report 100% of the net rental income, under just you or your wife. You should ensure that your reporting is accurate, as penalties may be imposed for incorrect reporting. Well, I've got to go now. Give me a call if you have more questions, or visit the IRAS website.
Join us for part 3 of this video series to find out more about renting out 2 or more properties, subletting a room, and other common scenarios.